contributor Tom Lee, the head of research over at Fundstrat Global Advisors. The chip trade, we've been calling it the epicenter, the tail wagging the dog of the markets, so to speak, for quite some time. But we did see a nice little run up in the midday session for many of these volatile memory stock names. How exactly do investors and traders reconcile the volatility versus what we could see in terms of long-term price appreciation for these particular types of stocks?
Yeah, Tom, I know it's been a very volatile week. If people have been long those names the last couple of weeks, it's been a rough ride. But these companies are at the center of one of the most important strategic initiatives for the U.S., which is AI and AI infrastructure. And that runway has years ahead, and they're going to report next week. So I think that this pullback's healthy. Leveraged funds definitely create more volatility. It is always creating an opportunity for the long-term investor, because if someone missed the DRAM trade or the semi trade and now they can buy it, or even Korea, and they can buy it 20% cheaper, that's the entry point. But yeah, it's very difficult. I mean, my institutional clients, many of them are having very difficult years because shifts in the themes or the winds or even visibility cause instant reaction, and it's something people aren't accustomed to.
Is leverage a factor in your mind? Forget about the world of leveraged ETFs, which is a different conversation that we can have in addition to what's going on right now. But from a margin debt standpoint, from a people understanding whether or not they should be long short-term something or short-term something with push-button liquidity, as you point out, is that something that we should be fearful of? Has it reached a point where we could see further market structure deterioration, the likes of which we have not seen up to this point?
100%. Margin debt today is now up 54% year over year, which is the 6th highest rise in like 60 years when you look at monthly data. And the other 5 times, similarly, the market consolidated over the next 6 months 5 to 6 times. Because when that cohort of traders is tapped out, they borrowed money, the market is vulnerable to a drawdown, which is what happened in Korea, right? In Korea, I believe the data is 1.2 million brokerage accounts had a margin call, and that may be as much as 10% of actual adult brokerage accounts. I mean, some massive, massive correction followed. So could that happen in the U.S.?